Good evening, everyone. So I do hope that you have a good time when you're staying here, as much as you enjoy the forum during these several days. Forget about the PM 2.5 and the hot weather. Okay. As the forum is drawn to the end, we still have the last session. Not last but not least session, and the paper is really interesting, so I'm not going to waste time. The topic here is weaponizing financial firms as surrogate regulators, general relation models and limitation, presented by Professor Christopher Chen from National Taiwan University. So you have like 15 minutes, as everyone's already know. And after that, we're gonna have a commentator from Professor Kyung-Hoon Chun, very difficult to pronounce, from Seoul National University for 10 minutes. And afterward, we're gonna have the floor for question and answers. Okay, so let's start it.
Thanks for the quick introduction. I'm fully aware I'm the last installment, so I will try to be quick. But before that, I quickly respond to John Wei's point just a bit earlier, is that China's the investment protection center you mentioned actually the original idea was from Taiwan. So we have like investor protection center, which is kind of active nowadays, not only to sue people, but also to sue people that already resigned 5 years ago. And they are also thinking about how to do more ESG stuff. So yeah, so they could be more for like a comparison study in the future. But anyway, back to my point. My paper is Weaponizing Financial Firms, a surrogate regulator for governance issues. So I will try to make it quick. So my idea is like that. So during my research on sustainable finance, okay, those issues when I study banking insurance regulations, it came upon me that one of the phenomena was that regulators nowadays, not just about regulating the market directly, sometimes they actually try to cause financial companies, okay, if we define broadly, to including banks, insurers, capital market firms, etc., to kind of regulate other market participants to achieve certain goals. And to sum up on the 2 wonderful days of discussion, I think those goals can be about ESG, it can be about some kind of public policy, it can be also about responsible use of AI in the future maybe, it can also be about kind of activism, right? We want financial firms to be a bit more active. So now we will start my research, right? Can the state, generally speaking, use financial firms as a kind of indirect regulator to regulate the market alongside other regulatory tools? So some examples, internationally I think is well known. Right after the war against Ukraine by Russia, there was a lot of sanctions, and including stopping Russian bank from accessing to SWIFT and their some banking. A more recent example was last year in Ghana. IMF and the World Bank threatened to stop funding to Ghana because the country of Ghana has a kind of anti-LBGT laws, something like that. So it was in the news. I didn't follow up, but it came upon me, the talk about using financial firms, okay, broadly defined, as a kind of surrogate or indirect regulators it's not actually something new. The term surrogate regulator had been used before in the case of insurance. So during 18th, 19th, there's been some talks, papers about the director of liability insurer, director and officer liability insurers, as a kind of vehicle conducive to regulate corporate governance of listed companies in the States. And I think there's still a lot of literature on liability insurer and corporate governance in that regard. And similarly, there has been some papers talking about the role of liability insurer for environmental issues, toxic waste, partially because there are some legal liability attached to dumping like toxic materials in the environment. And during the past 20 years, we also witnessed the role regulate the state are actually using financial firms as a vehicle to regulate or achieve certain goals, if not strictly speaking regulate. And they tend to be more mandatory in nature for public policy reasons. For example, there's been a lot of use of AML and CFT to counter money laundering for crime, terrorists, notably on banks to achieve public policy goals. In Taiwan, for example, due to rampant fraud, I have to say, we Taiwanese are happen to very good in explore one thing, not only about chips, we are also happen to be very good at cheating people, including our own people. My mother was a victim of that. But anyway, so Taiwan passed a law in the last year to kind of upgrade the measure against fraud. And among those other law enforcement mechanisms, one of them is that they empower the regulator to force banks to actually suspend bank accounts that are linked to fraudsters. So in a way, banks now a part of their important job is to actually regulator make it a goal. They need to tell the regulator how much they do to counter fraud. So as a way, banks have been used as a kind of a country to counter fraud. And that made me thinking, how about other ESG, governance, sustainable DEI, whatever issues? And as it turns out, the issue is not new, right? Over the past 20 years, we have seen a lot of initiatives such as Equator Principle, that was in 2003, Poseidon Principles in 2019. Those two were kind of an industry initiative. So Equator Principles are mainly for project finance. Poseidon Principle come from shipping and banking. The UN actually picked up the idea, so they have quite a number of initiatives in various areas. They all link to UNEP, but UNEP actually, on face of it, is about environmental program. And include, for example, the PRI, Principle Responsible Banking, Principle Responsible Investment, Sustainable Insurance, etc. And to broaden the scope, I think a stewardship code kind of also fit the bill, because even though it's probably more national law, because the idea is similar. We want institutional investors, some of them are actually financial firms, to kind of incorporate some environmental and social concern into the practice. So all those initiatives share the similar feature. Regardless of their legal device, they expect the signatory firms or those who sign up to the idea to incorporate environmental, social, or some other concerns into their services and practice, and not just about provision of services, but also about some other associated service, in order to achieve, make the world a better place, something like that. So let me to wonder, right? On the face of it, those initiatives, a lot of idea of regulation through financial firms has some kind of moral persuasion. I'm not really good with jurisprudence stuff, so all those really deep theoretical arguments. But I can sense there are some moral arguments, and I think it's in literature here and there. So people tend to argue that the financial firms, especially banks, they are the focal point of money, right? And because they are rich, they have money, so they need to take some responsibility. In a way, they are in a position to affect people's conduct through the provision of financial services or financial contracts. However, my question is it really the right thing to do? Is it really effective? And even if it is effective, and does it mean it can be justified in any sense? Those are my broad research questions. I try to structure paper in a more abstract manner, so I try avoid linking to a specific country. I do have a companion Chinese paper in Chinese, which more target Taiwan. So I try to make some general arguments. So it might sound a bit more general abstract. So some rationale. So why using finance? Why not telecom? I guess there are two underlying reasons. One of them is that financial market and financial firms are usually highly regulated. So which means that the state has a lot more influence over banks, insurers, and the financial service providers. Secondly, no matter what, people need money. People need money. No matter from banks, no matter it's from capital market, or even for risk management instruments like insurance, people need financial services. Then if you combine the two, it seems that the financial firms are easy targets, right? The state can influence, for example, banks to affect the conduct of their customers. So there's some natural appeal to that. And there could be some potential benefits, okay? For example, take money laundering as an example. It may cost money for the state just to track down the criminals and what they do in the bank, whereas the banks already know a lot of data about their customers. So in a way, it might just save some regulatory costs, enforcement costs. There are also some theoretical arguments saying that insurance companies could be a more efficient standard setter. For example, by Professor Ben Shahab. I took his country law class in Michigan, so it's usually nice to cite his paper. And solve information costs. And in some circumstances, financial firms actually naturally would do the job, right? For example, for liability insurer to reduce potential insurance claim, they naturally want to limit or control their customers. I trust many of us here have life insurance, right? I guess nowadays, for example, most life insurance has this program. So no matter you use whatever tracking device, smart, like Apple Watch, if you can sign up to your app to walk 10,000 steps a day, then you get some cashback or whatever. So the idea is that insurance company actually can have some natural incentive to regulate people, not necessarily regulate, to affect people's life for their own benefit. However, does it mean the approach is no problem? So I raised a few questions. So first of all, the state influence over financial firms is not absolute. It vary country by country, it vary sector by sector. And usually people talk about banks, but compared with banks, apparently capital market firms are much less regulated. So the influence over financial firm may vary country by country. So for instance, in Taiwan, banks are very obedient. Technically, they can do all the legal remedy they like if they got fined. But I checked the data in the past 5 years, only one single bank bothered to appeal against any penalty decision. And there was only one capital market firm tried to do that. But that case was because I think their boss had some problems. He didn't realize he will pay fine. And in some countries, like China, for example, all the big banks are technically state-owned. So they don't necessarily have to use a financial regulator. They don't need to use the IBRC. SASC probably can do the job, right? There are other means. But in contrast, in some markets, it just doesn't play like that. For example, last year or the year before, there was a news that the Federal Reserve tried to upgrade their final efforts to implement the Basel III Accord, the so-called Basel Endgame. And after the announcement, according to Financial Times, some US big banks, they not only write letters, they post there's a T-bar, the advertisement on the T-bar along the highway on the way to DC, and to protest against the Basel Endgame proposal. And eventually, the Federal Reserve actually back off. So that's subject to a lot of lobbying, politics, but it works in America. But it 100% don't work in Taiwan, I'm very sure. They don't want to please the regulator for a lot of reasons. So that's on the relationship between the state and the financial firm. In addition, the ability of financial firm to affect market participants also differ to some extent. So for example, banks can influence customers through loan relationship if the customer need to borrow money. But when they don't need to borrow money, the impact can be limited, right? So for example, I checked there's a database over internet on those green energy finance. It turns out I think 2/3 of them actually rely on equity financing, which means that equity principle may not be, sounds very nice, but it may not be that effective in practice. In addition to that, financial firms face a lot of competition. They have their own business interests, and sometimes the easiest way to avoid certain risks is not to regulate the customer to higher standard, is simply to reject a transaction, right? For instance, if the company's corporate governance standard is really, really bad, I think the better way to get out of it is to refuse to offer insurance, right? Rather than say, we offer you insurance, but you need to do this or do that, right? And in addition to that, there are a lot of transaction costs. For example, if the purpose is to reduce carbon emission, and not only banks need to have information, but also the information need to come from the customer, which costs money. I think yesterday, the 2 sessions in the afternoon talk about a lot of disclosure practice. But one thing seems to me missing a bit is there are costs to acquire information. So it costs money to not only to kind of verify, to identify the amount of carbon emission, but also it costs money to validate. And we are not just talking about scope 1, scope 3. If this is not only scope 1 and 2, if it is about scope 3, it costs even more money. So there are costs. There are also costs to monitor the market participants. And there's a limit on how far you can do. For example, for stewardship code, I think it's seeing a lot of literature saying that they must be about engagement, right? Engagement. But the truth is, it costs money to engage, right? I think Babcock is a paper saying that for large ETF, for example, investing all SP 500, you need that many people to talk to those 500 companies on a regular basis. It's just not going to work in many markets, I suppose, right? And in addition to that, there are also governance issues. It is one thing to say the bank need to do this or do that, but how do we know when the CEO says something, the employee actually follow? So there must be an internal structure to make it happen. And there could be some defect, it costs money to do that, right? So all in all, I try to sum up quickly. So my argument is that, I actually try to decorate my argument a little bit, so try not to be too negative. I think there are costs to using financial firm as a surrogate regulator. And if we cannot sufficiently address those costs and forcing financial companies to be a surrogate regulator may result in some kinds of window dressing or so-called washing activities. So I think we don't need to think too far about banks, just ask ourselves, right? If the university asks us to write a sustainability report for each faculty, what will we do? Listen, I mean, I will assume 90% of us will basically bluff, right? Say, I walk out the 6th floor stairs to office rather than taking the lift. But if we are forced to that, but if we don't have that much to say, the best we can do is just bluff. And I suspect that might contribute to some washing. Taking one example, Taiwan's regulator actually pushed for sustainable bonds, green bonds. So it happened that there are two bankers from one of the public banks. They were in my class to OD. And I asked them, what do you do about those bonds? He said they just bluff, right? Because they don't know what the money is for, but they still want to issue the bonds to make the regulator happy. And that's greenwashing, ESG washing. In addition to that, there could be externality on customers. So money laundering is the most obvious example. It's not news that a lot of crypto companies cannot open even a bank account simply because their money laundering risk is way too high. Similar things can happen to some other ESG or whatever it goes. And if it becomes too extreme, there could be financial inclusion issue that in turn may affect the integrity of the whole financial system. There are economic costs. So all in all, my argument would be that the state should be cautious about weaponizing finance or financial companies as a regulatory vehicle. And it kind of explains why the UN mostly adopt a voluntary approach. They don't force people to do that. However, I do a very simple number checking. I think in those principles website, they all claim there are hundreds of companies signing up. But if you compare with the number of financial firms, banks, or investors in the market, they are actually not a lot, right? And so therefore, the caveat is that I think the state should actually avoid overly turning those ideas into mandatory rules. And sometimes it may be better, at least for developing not the major market, like Taiwan, for example, just to wait and see, right? So don't jump too fast, right? Because nowadays Trump kind of changed a lot of things. And Taiwan, for example, our banking regulator forced the Banker Association to change their guideline to incorporate the equator principle into their guideline for offering credit, for credit assets, for enterprise to enterprise loans, right? Not for individuals. But that's where I want to cautious. There are costs attached to that. Either erase greenwashing or it might, in the end of the day, cut off a lot of small enterprises for their bank loans. So in the end of the day, does it mean the approach is useless? So I will argue that, well, financial firms are still in a position to be a regulator for some, but there are limitations. So on the one hand, I think there must be clear goals and targets. So we don't want to encounter a situation where a factory owner, for example, cannot acquire a loan because it cannot meet the ESG requirement or whatever. And it might become employee question like we discussed yesterday, right? And there must be clear goals. And the regulator also need to find a way to reduce transaction costs. Disclosure, I think, is one step, but a further question is where do the information come from, right? There are costs that need to be kind of addressed to make the market work. And personally, I'm in favor of making the market to decide. Based on their interests, they will induce them to do the right thing, but rather than forcing them to do all the stuff. And in the end of the day, finance is just one weapon, and it may not be there could be some other regulatory tools in the repertoire, right? So for carbon emission, for example, there are talks about carbon tax, carbon quota trading, but using equator principle, those principles may complement the approach, but it shouldn't be used as a sole weapon to regulate ESG or achieve other public goals. So those are quickly my main points in my paper. I welcome any questions or comments. Thank you very much.
Thank you for great presentation, Chris. You can see that. Okay, it's my great pleasure to serve as a commentator to this wonderful paper by Chris. Actually, I really enjoyed reading your paper. It was very thought-provoking and very interesting. So let me, Chris already provided a very good summary of the well-organized paper. So I may not need to summarize it again, but nonetheless, I will do it again, just to refresh our understanding of your great paper. So I understood the basic structure of your argument like this. So on the one hand, the state holds power over the financial firms because these financial firms are subject to basically heavy regulations. But this power is not absolute. So it may be limited by the varying different regulatory intensity. For example, the banking services and asset management services are subject to quite a different degree of the regulations. So that there may be some differences. And on the other hand, the financial firms hold power over their customers or the general public, because they need money, because there's always a market demand for finance. So the financial institutions always has some kind of power over the individuals and businesses that require the money. Of course, this market-driven power is also constrained by the fact that, for example, as you mentioned, the high elasticity of demand, or the transaction cost. For example, if the consumers can easily switch their bank, then the bank's power over the consumers may be limited. So anyway, the state has a power over the financial firms, and financial firms has a power over the people. So empowered by these leverages, the state may use, or in a position to use, the financial firms as tools for the state policy. So that is the basic structure. So, and then under this, the structure, you provided 3 models for these using or weaponizing the financial institutions as the regulator or surrogate regulator. The first is the private ordering model. For example, the insurance company is an example that Chris cited. For example, the health insurance companies will be very unhappy if their subscribers are heavy smoker. And the car accident liability insurers want their subscribers to be careful drivers. So in this sense, the insurance companies has a good reason to do something to make the public more careful and more healthy. So that was some of the examples that you cited in the paper. Also, there is the second model is the mandatory model. So, for example, the counter-financing of terrorism or the anti-money laundering are the typical examples where the financial firms, especially the commercial banks, are utilized as a tool for fulfill certain government policy goal. And third one is the voluntary code model, the non-binding ESG initiatives that Chris, you just explained in detail during your presentation. So in this case, this is not mandatory, but not just the private ordering, but the financial institutions adopt the soft norms, which is aligning with policy preferences of the government. So based on these structure, you suggested that we need caution against over-reliance on this using financial firms as regulators. And the state must align the regulatory objectives with the business incentive and should try to reduce the cost to improve the effectiveness. That was the basic story of the paper that I understood. So my overall comment is that this is very interesting to read. It's this very strong paper with original framework, and the concept of a surrogate regulator is both intuitive and powerful, and very easy to understand. And the analysis in the paper was very neatly structured and very comprehensive. And the three-prong model of the private, mandatory, and voluntary, it provides a very useful analytical the tool, very intuitive. And I also appreciated the balanced tone and nuanced analytical tone. I really like that. That said, I do see some opportunities for further development. First, probably this paper already reviews various examples of each jurisdiction, but if you could see more kind of the structural jurisdiction to jurisdiction comparison, either in this paper or in another spin-off paper, it would be very interesting. And you already during your presentation, you already explained or provided much more concrete the prescriptive guidance. So I think it's good. And another point I want to raise is that the financial firms, sometimes they are not simply rule takers, and sometimes they have a hand in shaping the rules themselves. And that dynamics could have important implications for your analysis of the surrogate regulator. I would just add a few additional examples that may support your story or your idea. Some of them you already mentioned during your presentation. For example, there's the so-called targeted lending programs. The banks are sometimes the state officially or unofficially ask the banks to provide low-interest loans to specific sectors as a part of the policy to achieve the policy goals. And also there's a kind of restrictions on bank loan for stabilizing house price. It does issue in Taiwan and also issue in Korea. And Korean financial institutions are always under the pressure from the regulator about this issue, this kind of mission, the stabilizing the house price. For that purpose, usually the Korean banks restrict the loans, like a loan-to-value limit by applying the LTV or debt-income ratio or debt service ratio. All these the pressure or restrictions come from state to the banks. Sometimes based on clear law, but in many times based on some kind of guidance. And also there are some restrictions on consumer loans to prevent over-indebtedness of the household. And these would be the examples for the surrogate regulator function of the financial institutions. So let me ask you a few questions. So first, I'm curious about whether it is effective to analyze the insurance companies and commercial banks under the same umbrella of finance, because they operate under quite different the risk models and regulatory expectations. So, for example, in your paper, the private ordering relates mainly to the insurance companies, and the mandatory ones mainly relate to banking, because the banks are the gatekeeping the flow of the money, while insurance are not in that position. So I'm just want to ask whether it is effective or proper to analyze the insurance companies and commercial banks under the same umbrella. And as I pointed out in the previous page, in some jurisdictions, the larger financial firms are not simply rule takers, and they may play roles in rule setting as well. So does it affect your framework of a surrogate regulator? Because in these situations, the financial institutions are not just the tools, but design of the tools as well. So, another question or comment is that, is there any specific jurisdictions or sectors, business sectors, where this model, your surrogate regulator model, has particularly strong explanatory power? If it is so, then which is jurisdiction or which is sector, and for what reason? And finally, I'm concerned about the using the financial institutions as a tool with conflicting with the financial firm's directors' fiduciary duty. If you require the directors of the financial firms to act as a surrogate regulator for the state purpose or government purpose, then probably it may be conflicting with the financial firm's interest and the shareholders of that financial firm's interest. So in that sense, we may need to distinguish between the listed and unlisted financial firms, because the dynamics would be very different. In case of the listed financial firms, there are many shareholders who are not satisfactory to what the financial firms are doing, if that is not directly related to their profit. So I'm just raising these questions. So much for my comments.
So you're gonna answer first, or okay?
We can do the Q&A.
Okay, yeah, we can do a question and answer.
Thanks for your. If a company want to go public, it need at least 3 years. We call it the legal coaching program. So, which means a security company must be a coach to help the the company want to go to want to go public to do all the stuff to follow the corporate compliance program required by the listed company. So my question is, in China, if the coach the company go to the public capital market, become a listed company, there are some mistake. As you mentioned, the mandatory surrogate investor bank didn't fund the problem. In China, it's very, very arguable issue. This investor bank needed to be take jointly liability for those faults, for those misconducts. So how you explain this? if there more time, I want to make a comparable, another example. So recently in China, we have a slogan called the social cooperative governance. So not like the bank, not the bank, but the platform enterprise. So the problem is that those platform enterprise like Ali, like Tencent, so they needed to serve as a surrogate of a regulator, actually like you described. But the key point is all the information those platform enterprise collected, the government have a right to use that information. But the government collected many informations, like those market regulation agencies, some bank regulation. That platform enterprise cannot use the government information. So that's a huge asymmetric situation in China, which caused a serious problem. So those platform enterprise ask the government, I cannot take this kind of responsibility for your regulation. So that's another example. So I don't know whether you mentioned the mandatory surrogate regulator, whether did you consider the information flow, the directions of this kind of symmetric information flow? That's all. Thank you.
Let maybe respond to the question first.
After, or do we take questions?
Yeah, just take it shortly, and then we will take the question later on.
Thanks, Professor Dan, and for Professor Chang for the comment. I quickly respond to both of you. One of them, I'm not too familiar with China's situation, of course, but in my imagination, the way you mentioned also, I guess in South Africa you call sponsor, right? Do the sponsor investment firm or security firm need to help companies to go public? And I have no deep research on that, but in my understanding, I think having joint liability is not. I'm not sure it's about unique Chinese, but certainly in Taiwan, it's probably not the case. But I get your point. It's all similar to Professor Chung's comments that in this paper, I try to go general, provide a general theory. But they are more to go deeper in China, other parts of Asia, Taiwan, even America, to how things may play. So from my view, I think what you mentioned about those security firms, they might actually be one of the examples. But I don't want to push too hard. Otherwise, every time you use whatever financial firm, you become a. But I do think those sponsor or kind of those security firms coaching companies to go public, maybe one of the example. But it's not strictly speaking about ESG or whatever. But I think it does serve the purpose to kind of use it as a vehicle to kind of enforcing or kind of do quality control on companies that are going to public. So in that sense, I think it's closer to my idea. But of course, you need to interact, particularly in the Chinese context, and in the security under the kind of framework of securities laws. And regarding information flows, I haven't gone much into the paper, but there are areas in some areas, for example, for money laundering, I think globally, government don't necessarily count only on banks to produce information. There are some intelligence issues for terrorism, for example, cyber attack. So, but my point is that some form of information sharing, on one level it could be global, but domestically, even among government agencies, I think it's also important to share information. But things can get a little bit tricky if government want to share with, let's say, banks. And the legal issue certainly will vary country by country. In some places, I think the data protection law will, but as far as Singapore, for example, Singapore law actually open all the battle for government, right? Government can do anything under data protection laws. I mean, it's too simple to say that. But what I'm saying is that there could be legal issues. But I do think actually that's the direction I want to go is for certain information, the government should take more responsibility to make the approach work. And quickly for Professor Chung's comments. I think you summarized my paper better than I do. But just a couple of things. On the one hand, I think similar to President's comments that you need to go a bit deeper in the future about, that's why I intend. I have a Chinese paper more about the Taiwanese context, but I think in the future we can compare for what to do in Singapore, for example, China, Japan, Korea, America, even Europe, to see how I cannot do all of them, but how things play out in specific areas, not just in broadly speaking finance, but also banks, insure. And I also take your point on rule setting. I think Ben Shah, he was in Michigan when I was there, but he later changed to Chicago. And I really admire his course, right? Very thought-provoking. I think he has a paper on rule setting by insurers, something like that. So that's one direction to go. But one thing I want to mention is that when I say the private ordering, of course I don't limit to insurance, but it's just the most obvious example. I did thought about using bank covenants, loan covenants, but eventually I saw, instead of making the paper too big, I just keep it over there. But idea is there, just not only insurers through insurance contract, but also banks can through loan covenants, through other kinds of contracts. Investment fund is a bit difficult because they mainly through investment decision or their post-investment management function to do the regulation driven through contract. But I do take your point. And lastly, I think I haven't solved the fiduciary part, and that do give me a lot of food for thoughts. And that actually also linked to another previous session when we talk about fiduciary duties, corporate purpose, and those kind of statutory reasons. Like actually throughout the whole event in those 2 days. So thank you for your comments. Yeah, we can take more questions.
Okay, so Dan.
So just very. One point to add to maybe further evidence for the cost of stewardship, and it comes from what Jennifer said earlier in this piece that Umakan and I did. So I completely agree with you. There can be a cost, and stewardship has, I guess, forced people when you have these voluntary codes, but they run up against these hard acting in concert rules. And so you get this sort of what we call faux green activism, right? Where they spend a lot of time talking, but they actually don't do something. But I guess the more, I think one point that you may think about adding, but I'm not sure if it works, is there are lots of costs, but there's also benefits. And again, I'm speaking about stewardship, right? And there's a very interesting empirical piece by Charles Wang and a colleague at Harvard Business School, where they've actually now, it was featured on the Columbia Business blog. It's called Stewardship Codes and Shareholder Voting on Contested Ballot Measures. And they actually proved that this idea of halo signaling plays out empirically at the firm level in practice, saying that countries actually benefit by passing these soft regulations. And why do they benefit? Because they make them voluntary, so they don't actually have to be put into practice. But this draws in a lot of capital. And maybe there is a cost side to this, but there could be a benefit to passing these environmental regulations, which are not binding on the financial institutions. So the financial institutions don't have to do much. But if they actually bring in capital, right, that could be a driver of doing this. So maybe actually in that situation, the benefits outweigh the costs. And this is a calculus that places like Singapore and some jurisdictions have made. Yeah.
Actually, time is out.
Yeah, just quickly. Thanks, Dan, for the comments. I think, I highlight too much about cost, I admit that. But I agree there are some benefits for that. No matter it's for signaling reason or maybe there are other more tangible benefits. But what I want to argue is that a lot of commentators focus way too much on the nominal value of that potential right thing to do, but without thinking about too much about other potential. But I do agree with you. The overall impact, the efficiency need to be accessed on a more general level, not only about the cost, but also on. But that may be something that I will try to do more in the future. I also know there are a lot of business school research trying to do peace and peace. I think in due time we may be in a better position to have a full access, not only in Singapore, Taiwan, but also maybe globally to see how those UN initiatives, those voluntary codes may actually play out in the end, in due time. Yeah, thanks very much.
Unfortunately, I think time's is out already. So thank you very much for two professors for presenting and commenting. Okay, so we have, I think the last session already ended, and then I'll just move the floor to Dan. Okay, thank you.